I've been with Barenjoey since basically the firm started about 3 years ago. Before that, I was working at Credit Suisse for about 17 years. And then prior to that, I used to work at the Reserve Bank. And the thing for me is, having grown up in central banking circles, we always used to look at gold as kind of that barbarous relic that nobody really understood. And the reason why we had that view was because central bankers kind of need to believe in stability. When I left central banking in about 2006, I found out how wrong that actually was. In fact, we need to position constantly for instability, and we need to know how to diversify our risks. And so today what I want to present to you is sort of a longer term picture as to why we think gold is actually a really good long-term investment and why we think there's actually an opportunity to be getting longer in the space. The common view out there is that gold is an inflation hedge. That's kind of half true, but it's not the whole truth. The truth about gold is that it's an instability hedge. So it protects you against high inflation. It also protects you against deflation. Deflation is basically when you don't have a lot of faith in banks to keep your deposits. You don't have a lot of faith in the value of your deposits because you don't know whether it's going to be there tomorrow, or you don't know whether it's going to be inflated away by some sort of government policy. That's when you kind of need gold. And what I want to put to you today is that actually we are going into a world where the uncertainty about where we are headed with inflation is extremely high. So I don't actually even need to present to you a view that inflation is going to be in double digits or it's going to be zero. It actually doesn't matter. What matters is that we just do not know enough about the inflation dynamic going forward, and that in itself is a reason to be buying gold. Now, I do think that central bankers are very wedded to this idea of getting back to a 2% consumer price index inflation target through time. They're doing their very best, and in fact they have done a very good job of getting inflation back to that level. The trouble is, the next leg down from, say, 3% inflation in the US down to 2% could actually be quite painful. And what you're starting to see are central bankers around the world are starting to fray and maybe lose a bit of conviction as to how seriously they want to get inflation down to that 2% mark. I believe that there is a window of opportunity, maybe one more shot at trying to get this down, but it will involve pain, and the distribution of that pain will be, I guess, the thing that's topical. In particular, I think that China has got a few issues that it needs to deal with, particularly if you do get a Trump election victory. So I think China is about to bear a lot of pain, and in that scenario, you will find that China will be in deflation, it will be exporting deflation to the rest of the world, and that will be helping inflation to get back to 2%. But if you think that issues in China will be confined to China, I think you'd be wrong. Because we know, for example, that China is a massive holder of US Treasuries. If China were to face massive capital outflow from its economy, so devaluation pressure on its currency, reduction in its international purchasing power, I think what you would find are two things would happen. One is that China would be selling its bond portfolio, and two, it would have to park the proceeds into something else. And so what you have seen in the last little while is that the Chinese have actually been quite forward-looking, and what they have done is they've diversified their bond portfolio into things like gold, which helps to explain why gold went absolutely ballistic a few months back. That's a big thing. I also think that as we go forward here, there is this question about sovereign debt risk. Not like what we saw in the European crisis about a decade ago, but more in terms of the cost of printing money is inflation. And there is a bigger risk premium that investors will demand in order to buy government bonds. They won't exactly be the happiest campers to buy this stuff for near zero yield. So I think there is this little window of opportunity where central bankers will try to get inflation down, but as I said, it is going to be a very painful process. The distribution of that pain is going to be in question. And very recently, like literally last Friday, we saw Fed Chair Powell come out and basically say, listen, now is the time that we want to be cutting rates. Well, this is a very interesting thing to say because now is the time and you haven't actually got inflation back to 2% yet. So that's kind of telling you exactly where central banks' sensitivity actually is. They don't want to go there. They don't want to push us all the way back down to 2% by force. They'd rather allow some accident to kind of happen, to allow that to happen, and then try to clean up the effects afterwards. But as I said, gold is an instability hedge. It helps you in high inflation and it helps you in deflation. And it helps you in particular when you don't know where inflation is going to be going. I might just skip forward to the next slide if that's okay. Actually, in the next couple of slides. I'll just use this guy. Okay. Wrong way. Sorry. This way? No. Top green button. Okay, great. No, not working. Okay. So here's a chart that a lot of people put up there. It shows you the relationship between gold and an inflation-adjusted bond yield, and they're negatively correlated. And the reason why I want to put up this chart is because it's wrong. And you can see that it's wrong. Because as you get to the end there, what you've seen over the last little while is that after inflation interest rates, real interest rates, they've gone up, and the gold price has gone up too. What I'm trying to say here is that there's actually a bit of an oversimplification, that it's just a story of interest rates dropping that supports gold. It's a far richer tapestry to explain what's going on. I'll skip these. Okay, here's the key chart that I wanted to talk to. If you're a multi-asset investor, so like say you're a Bridgewater or Wellington or one of these really big investors in the world, how do you design your portfolio for the long term? Well, what you want is kind of a cheap entry point into the things that you want to buy. And then the second thing that you want is diversification. That is, if you're investing across a lot of different things, you want some things to go up, you know that some things will go down, but on average you will win. That's kind of what you're after. Mathematically, we call that zero to negative correlation between the things that you invest in. So the orange line that you see there is sort of on a rolling 3-month basis. It's kind of noisy, exactly what the correlation between bonds and stocks is looking like. And in the last little while, well, actually you can see that that correlation has become quite positive. That is, if you're a big investor and you hold 60% of your money in bonds and 40% of your money in equities or vice versa, you actually haven't seen much diversification in your portfolio at all. What you have seen is that when interest rates go up, your equity portfolio would be down and you'd be looking at your whole portfolio being down. Or if interest rates go down, you'd be seeing your equity portfolio and your bond portfolio being up and you'd be happy as Larry. But it's an enormous amplitude that you'd be seeing in your portfolio performance. So you might get a return, but you wouldn't be very happy with the risk and the amplitude of the movements in between. What I want to suggest to you is that the key driver of this correlation, which incidentally is very important because these are the two biggest asset classes in the world, is actually how uncertain we are about inflation. Not inflation per se, not like whether it's 2% or 3%, but if I ask everyone in this room, you know, what are the different views as to what you think inflation has been or will be, like the spread of those views is what I'm interested in. So that's the dark green line, and this comes from the University of Michigan. They produce a monthly survey, a big panel of consumers, and they ask them, you know, what do you actually think is going to happen with inflation in the long term? And you get a big spread of answers. And right now what you're finding is that even though inflation is coming back from, say, the 8s down to about 3, you'll also see that actually the spread of views as to what inflation is and what it will be is huge. What this is telling you is that people aren't just looking at the past year to judge inflation, they're looking at the past 3 years, 4 years during the pandemic. They're looking at turning points in the cycle and thinking, we just don't know what's going on. I mention this because inflation can be good for stocks, because some companies have got pricing power and they charge higher prices in a high inflation environment. Inflation can be bad for stocks if it means that wage inflation is going through the roof. But inflation is almost always bad for bonds. When we talk about uncertainty, what we're now starting to say is, well, hang on a minute, never mind the level of inflation, the dispersion of inflation views, is that something that's good or bad for stocks? Well, that's unambiguously bad for stocks. It's also unambiguously bad for bonds. So when you have high inflation uncertainty, you should expect to see bonds and stocks move together and probably to the downside. The bottom line here is that the level of inflation uncertainty as of this month is so high that you should not expect to see much diversification in a bond and stock portfolio. So you can see this every day. You're riding a roller coaster. We're wishing for Fed Chair Powell to cut rates or Michelle Bullock to cut rates. And we're kind of happy with that. But the amplitude of the movements that we see in our portfolios every day is pretty big and not exactly what we signed up for. So this is a key chart. I don't think that going forward we are looking at much diversification in a normal portfolio. Sorry, stopped. Okay. Now, why are we so uncertain about inflation? It's a good question to ask. Is it just that we have had high inflation in the last 3 years and we just don't know what we're measuring? Is it because going forward there is a turning point? Well, those things are real. But what I want to suggest to you is that there's something else that's happened, particularly after the pandemic, and it's called fiscal dominance. What this means is that higher interest rates go hand in hand with stronger economic growth. Now you might say, well, that's kooky talk. Well, how can that happen? Well, let me explain. In a normal banking system, bank loans create deposits. The other way of creating deposits is through government spending. When you have a pandemic and government spending has gone vertical, then you should expect to see that deposits greatly exceed loans. When you look in America, America is an economy where people are largely on fixed rate mortgages. So if you raise interest rates at the short end of the curve, you are not actually hurting the incumbent borrower, but you are hugely benefiting the saver who has now outgrown the borrower. So what you find is that interest rate hikes are actually benefiting the economy. They're actually stimulating the economy. On top of that, as you raise interest rates, what you will find is that the US fiscal deficit, at least half of it going forward, will simply be interest payments. So if you don't think that inflation and rates are going to come down in a hurry, then actually we have a very perverse situation where higher rates are stimulating major parts of the economy. For that reason, policymakers actually don't really know what the best direction for rates is. Do we say higher for longer rates and just keep them there and hope for the best and say savers win over borrowers and things like that? Do we try to drop rates? We don't know. And similarly, because we don't know what central bankers' ideal response function is, we therefore do not know what inflation is going to be, because essentially they're stimulating and tightening at the same time, and that's a very uncertain mix. To me, this is the key reason why inflation uncertainty is so high. It's also the key reason why there is no diversification in a conventional bond stock portfolio. A big issue is the US dollar. So how significant is the US dollar in policing global inflation? So let me back up a little bit. Historically, ever since Bretton Woods, we've had what we call a euro-dollar system. That is, although the US is the only one that can produce US dollars, we have a lot of users of US dollars outside of the US jurisdiction, to the point that people borrow and lend US dollars outside the US, even though they're not necessarily US residents. This is a big thing. It means that the US actually has a lot of control over global monetary conditions. And so what you would expect if this system is working well is that if the US dollar goes up, then what you'll find is that the supply of dollar liquidity that's out there in the world tightens up. And given that you've got so many people that are trying to use US dollars and more scarcity about them, you would also expect to see emerging markets, any US dollar earner really, or US dollar receiver, tighten up their activity level, and that will drop commodity prices and that will drop inflation. So that's historically been the link. Now, what you can see here is that the US dollar has been flipped upside down. That's the dark brown line. And the tan line is the spread of inflation outcomes that you see globally. So, US can have 2, or China can have 0, India can have 8, that sort of thing. And what you can see on this chart is that actually the logic is largely true. As the US dollar strengthens, you tend to find that the spread of inflation outcomes tends to tighten because you are effectively, the US is effectively running global monetary policy. But what you've noticed ever since we had Russia, Ukraine, and a lot of geopolitical issues and COVID is that actually the correlation flipped the other way around. A stronger US dollar was not policing global inflation very well. More recently, what you're starting to see is that as the US dollar is strengthening, the Chinese economy is now coming under tremendous pressure. And the belief is that if you continue to exert that pressure on China, that China will fold, it will go into some sort of recession or deflationary regime, And in that scenario, then China will not be exporting expensive manufactured goods, and that will be helping to lower inflation. That is kind of the last-ditch attempt to make this system work. I'll skip that. So here's a set of charts that basically show where the Chinese yuan is. So the tan line is basically the actual market price of the US dollar against the Chinese yuan. The green line is basically what the futures market is predicting the US dollar yuan should be. And that's actually now suggesting that the US dollar needs to devalue against the yuan and that the yuan needs to appreciate in value. However, if I were to run a fair value model using interest rate differentials in terms of trade and things like that, what you'll actually find right now is that the yuan is actually extremely overvalued. The US dollar is cheap against the yuan. So there's a lot of divergence of opinion here. Because China is a fixed exchange rate, it's not exactly easy to know what its fair value is. But suffice to say, there is a lot of risk. And the big risk that is approaching is, of course, Donald Trump. Because if he actually succeeds, and if he does impose that incremental 60% tariff on Chinese goods, you would expect that China would lose some advantage in its competitiveness, export-wise, and it would attempt to nullify that by dropping the value of the yuan. So this is a key political risk. But as I mentioned at the outset, China has actually been a bit more forward-looking than that, and they've actually now started to do things to position for that day when they do have to drop the yuan. And one of the things that they have done is to stockpile metals, and in particular precious metals. Here's a chart that basically shows the tan line, how is Chinese electricity output growth going, a measure of activity growth. And then the dark brown line is what I call a measure of financial conditions. It attempts to see, given where interest rates and the exchange rate are, where is Chinese growth headed? And the answer is Chinese growth is not headed to good places right now. The question is, do you think that China will actually be happy to put up with that indefinitely? And my answer would be no. So how does China respond to a situation where growth is under pressure, money's going out the back door? Well, this chart shows you that if, in fact, China were to reduce its holding of US Treasuries, that dark brown line, it's on a reverse scale, would go up. That would actually push up bond yields. So if I go back to that original chart that shows that bonds and stocks are moving together, a higher yield means that bonds are selling off. So if that actually comes to pass, both stocks and bonds would sell off. Where would you hide? That is really the question. Here's a slightly more complicated chart, and I'll close on this and leave it for Q&A. What I've done, instead of looking at the correlation between bonds and stocks and trying to gauge is that zero or positive or negative, what I've done is I've said, well, what is the correlation between bonds and commodities? Looking at a basket of precious metals, oil, etc., etc. And what you'll find is that right now, all the things that I just talked about are pointing to the correlation between bonds and commodities being zero or negative. That is ideal for a multi-asset portfolio. That is exactly where you find diversification. Right now, the market is saying China weak, inflation down, commodity prices down, bond yields down, and US dollar down. But tomorrow, the causation path will be very different. And so in conclusion, I do think that you want diversification in this space. You want to be able to protect yourself against what we don't know. And what we don't know about inflation and the current dynamic is a lot. What we don't know about the geopolitics is a lot. And there is actually an ideal longer-term opportunity here to get into gold as a diversifier in your multi-asset portfolios. I'll leave it there and open it up to any questions.
Thank you very